Hello, ladies and gentlemen. My name is Greg Michalowski, and this is the March 4th, 2010 weekend Forex market technical review. During this review, over the weekend, we like to take a look at the markets, in particular the major currency pairs on a daily and hourly basis, kind of get a broad stroke view of where the market stands from a bias, either bullish or bearish, given the technicals that we look at. We like our currency pairs. We'll start off with the euro versus US dollar on a daily chart, and what is significant here is that we've been in this narrow trading range here for about 2 or 3 weeks here. You can see that we had some tops here at the 136.83 to 91 level. We broke through those levels on a couple of times this week, but each of the time the market was not able to close or sustain the move to the upside. The market is closing the week at 136.20. So we're below that 136.91 level. We're going to have to get above it to the upside to see further momentum to the upside. Off the daily chart, we do have this resistance up here at the 87 level. That is these highs right here, and also we have these lows at 137, 38.50, 52, and the 38.2% retracement of the move down from the January high to the March low here today. So this is a 2010 range, which is about 1,100 pips, 1,100 and I don't know 40 pips to the downside here that we've seen in the course of a 2-month period. So that's somewhat significant. So we could see a further correction to the upside, but we're going to have to get through this 136.90 level, and then we're going to get 87, and the next target would be this 50 to 87 area up here at this area right here. So that's what the daily chart is telling us. And of course, if the market does not move to that upside, we have a triple bottom here at the 37 to 51 level that the market's going to have to get through on the downside. Now let's look at the hourly chart real quickly, and you can see the up and down action here, non-trending action. You know, we have intraday trends, trend up, trend down, trend up, and then trend down, trend up, and then trend down. This week we had a couple days where the market trended up, and it looked like it was going to break to the upside. And then we had a couple days when the market trended down until Friday, when the market started to move back above our 100-hour moving average. Again, that's our trigger. We're back above that level. The 100-hour moving average comes in currently at 136.09. As long as the price can remain above 136.09, we should see further moves to the upside. Other levels off this hourly chart that are of significance is this 54 level. If you look back over time, you can see a number of different bars on the hourly chart that kind of stop at that 54 level. You can plain to see 1, 2, 3, 4. It came up to that level 5, 6, 7, 8. 8 or so different bars that on the hourly chart that came up to the 54 level and came down, broke through it, came back down, broke through it, came back down. Used as resistance, used as resistance, used as resistance, used as resistance, broke through it, went higher. It's kind of waffled around the level, came back down. So 136.54, key level for you to keep an eye out next week. The other level of importance is 136.91, and you can see the significance of that. That was our original high for the 2-week period until this week when we broke above it. When we started to come back down, we use it as support in this area. How many bars? A lot of bars right here at 136.91 area. Broke through it to the downside and then corrected up. Where did we correct up to? The 91 level. So these levels are important levels on the top side. Pay attention to them, and I think you'll find some opportunities to trade either against them, with a stop above, or look for a break if the market breaks above, and then look for further momentum in the upside. But right now, the bias is to the upside because we're above the 100-hour moving average. If we stay above that level, those are our targets on the upside. On the downside, let's watch the let's watch this 200-hour moving average. If market breaks the 100-hour moving average, we got to confirm the move to the downside by getting through the green line, getting through the 200-hour moving average, and that comes in at 135.80. If we break through that, then we're going to have support at 51. We're going to have support at the lows from Friday, and then look for this 13 level. Again, we had some levels at 13, around this 13 level of significance along this time period right here. And of course, we have the triple bottom here that has 44, 51, and 37 as the key levels on the downside for the dollar versus euro versus the US dollar. Take a look at the sterling versus the US dollar significance on this chart here. Daily chart is we came down and tested a 61.8% retracement of the move up from the 2009 low to the 2009 high. That retracement level came in at the 148.54 level. You can see that the market dipped below that level here earlier the week, but the next day the market used it as support and started its move to the upside. We're closing the week at 151.44, which is a strong close, especially given the move to the downside here. And we do have resistance off this daily chart at 152.72, which is 50% of the move up from 2009 low to the 2009 high. Now let's go to the hourly chart and we'll take a look at what that is telling us. And of significance here, I'm going to zoom in here, is this area up here. We have this old trend line, 1, 2, 3. We broke through it briefly here, but able to maintain the price back above in a short order. Came up to the highs here at 131, 151.35, and then started to come down, testing the 100-hour moving average. Now on I like this old trend line. I like this resistance, and look how the market came up and tested that old underside of the trend line right there and held that level. Also at that level was this green line. That's our 200-hour moving average. So the market went a little bit above the green line or 200-hour moving average, which is a confirming moving average, and failed. We failed up to that level. And so the market was not able to break through this area right here, and that's of significance. We may see further corrective moves to the downside on Sunday as a result of that, or alternatively, if the market is able to break above this 200-hour moving average, break above this trend line, we should see further moves to the upside for the sterling US dollar. So it's a very key point here on Sunday night, Monday morning. And Monday's trade to be able to see what happens against this area right here. If the market holds, we should see further corrective moves to the downside. We may head back down toward this 150.60, 66 area, on a good correction to the downside. But there's going to be other levels along the way that you're going to have to pay attention. But right now, if we stay below that level, this green line right here, look for further corrective moves to the downside, and we'll analyze where we can go on the 5-minute chart during next week's commentary. Let's look at the dollar versus yen. Take a look at the dollar versus yen. Here we do have the 100-day moving average, which comes in at the 90.15 level. Market's trading at close the week at 90.33, which is bullish for that currency pair being able to close back above the 100-day moving average. Note this week, what did we do? We went down and tested the 61.8% retracement at the 88.23. This is of this move from this low in November to the high in January. So in a nutshell, for the dollar versus yen, if we're able to stay above this blue line, above the 100-day moving average, we should see further moves to the upside. We could head up toward on a longer-term basis and come up and test this green line, test the 200-day moving average like we did at this point right here, and staying in between our goalpost, if you will, in between the 100 and the 200. That may be a target for the dollar versus yen. Let's take a look at the hourly chart in the dollar versus yen. Friday's move took the price back above the 100. Or we stayed above the 100-hour moving average and moved above the 200-hour moving average at this point, when the market was able to hold these levels at this area right in here. The market took up to the upside, went through the 38.2% retracement of the move down from this high to this low. At 89.66, and then went through the 50% retracement, also at 90.13. The 90.13 level is of significance. Why? Because if we go back to our daily chart, 90.13 there, we go back to our daily chart and look at the 100-day moving average. What's the 100-day moving average? 90.15. So 90.13, 90.15 is going to be of significance for the dollar versus yen on the downside here. So if it's able to hold that level, we should see a push to the upside. Now, what is of significance as well off of this chart is that we did hold the 61.8% retracement of this move down from here to here. That is significant. Why? Because look how many days it took to come down this slope from 92.14 down to 88.12. At least like 2 weeks of period there. We corrected 2 days, 61.8% of that move. The fact that we held that level may suggest that we see further corrections to the downside, at least temporary. We may come down. Let's put a Fibonacci on the move from this low to this high. Comes in at 38.2 at 89.66. So that's our major currency pairs as we head into the new week. Wish you all good luck with your trading, and we'll look forward to speaking with you again on Monday. Thanks a lot. Bye.